Let's talk more about the state of the auto business. Former Ford CEO Mark Fields joins us now. He's also a CNBC contributor and a member of Qualcomm's board of directors as well. Mark, always good to have you. I'd love you to just start off on GM. To be fair, the stock had been a very strong performer this year coming into earnings, but it is still down sharply on what seemed to be, at least, very strong numbers. I'm curious to get your take.
Yeah, David, as you said, listen, they had a very strong quarter, right? They said they hit records for profitability in North America. Global revenue. So it was a strong quarter. Their margins in North America were actually very, very strong, almost 11%. And I think, overall, maybe what investors are looking at with GM is, first off, they continue to pull back on their EV plans, but at the same time, they put in a lot of capacity. So that means, that capacity is going to take longer to get used up. And when you have capacity sitting there not used, that's a drag on your earnings. And then secondly, this news around they have to restructure China. That's a big operation for them. And then finally, they've abandoned their Origin autonomous vehicle when they took a $500-600 million hit on that. So that puts into question, what Mary Barra's been talking about in terms of the kind of robo-taxi kind of revenue they can get in the future. So I think a lot of things in there, but overall it was a good quarter. Their pricing held up, and the market's still relatively robust.
Yeah, I mean, I'm sure you face this frustration to a certain extent at Ford as well. This thing trades at 5 times earnings. I mean, I guess you're never going to get investors to pay up in terms of a multiple for these kinds of companies.
Well, that's always a frustration, right? Because if you look at the automakers, whether it's Ford or GM, et cetera, listen, they're doing a lot of work on EVs, a lot of work on obviously generating kind of new revenues through their vehicles being connected. But at the same time, investors always go back to the fact that these are highly capital-intensive businesses, and they never get the credit for that. And so, they're going to have to keep working through it. Or, at some point, they're going to have to deliver on their promises around, higher margin businesses, revenue streams through information from the vehicle that consumers are going to take advantage of. But, the investors go back to the fact that, they're a manufacturing company, and not many ways to solve that.
EVs used to be a little bit of a political football. But in this time it's different with Elon Musk supporting former President Donald Trump. I wonder if you think there is a big difference on either side as for the upshot economically and financially for the auto economy and EVs in particular.
Well, Sarah, as you said, I never thought in my career we'd see, automobiles become political. But clearly, depending upon, which administration kind of comes into play here, there's going to be some puts and takes for the auto industry. And, I kind of describe when you look at the candidates or the parties, you look at their policies and it's a bit like a box of chocolate, right? You bite into some you really like, you bite into others you don't. But clearly there's some, ramifications around EV incentives, supports for EVs. But overall, the industry over time is going to transition to this propulsion system because, oil is a non-renewable resource, but not at the rate everybody expected. And that's why you're seeing all these changes by the established automakers and the pressures right now that Tesla is facing because, again, going from early adopters to mass adoption is really hard. And we saw in the first half of this year, the growth of pure EVs was about 8% in the U.S. And last year, through the first half, it was about 50%. And also the premium from a EV to an ICE vehicle, an equivalent ICE vehicle, is down significantly. It's only about $1,500 more now on an average EV versus last year it was almost $9,000.